Hi everybody, Jacob Reed here from ReviewEcon.com. Today we're going to be looking at all the math that you need to know for your macroeconomics exam. If you feel like you need some extra help after watching this video, head over to ReviewEcon.com and purchase the Total Review booklet. It has practice questions, a practice exam, answers and explanations. It has a formula cheat sheet, a graph cheat sheet, and exclusive online practice games. If you want to pick up a copy, head down to the links in the description. Now let's get into this macro math. First off, we have Macroeconomics Unit 1 Math. If you already took microeconomics, you have learned that math back in micro, so go ahead and feel free to skip to Unit 2 if you're ready. In Unit 1, the first math we have is about opportunity cost. Opportunity cost is the value of the next best alternative not chosen. If you see a production possibilities curve on your test, you could be asked to calculate the opportunity cost of increasing production of one of the goods. If you take the new number minus the old number, that will give you the benefit or the cost of the change in production. So for example, if we go from point A to point B, we have a benefit of 45 units of consumer goods. Our capital goods are now at 80 units of output, but they were at 170 units of output. That means that the opportunity cost of increasing consumption of consumer goods from point A to point B is actually 90 units of capital goods. The most difficult math in Unit 1 is comparative advantage. That's the ability to produce something at a lower opportunity cost. That explains why most of our lobster comes from Maine, while our corn comes from Iowa. Has to do with lower opportunity costs. Let's look at an example. There are two types of problems you could get when it comes to calculating opportunity costs for comparative advantage. One is an output problem and the other is an input problem. Let's look at output first. The formula for outputs is the other over formula. That means the opportunity cost of A is the numbers you have for the other one, B, divided by A. There are two ways you can see an output question on the AP Economics exam. The first is two production possibilities curves. There'll be straight line production possibilities curves, and when you see these, you know immediately that is an output question. You could also see this as a table, something like this. This shows you the different levels of output both Jason and Henry could produce with their fixed resources. Let's work out this example. So the opportunity cost of A is the numbers for B divided by the numbers for A. That means Jason's opportunity cost for 1 ton of strawberries will be the numbers he has for zucchinis, 4, divided by the numbers he has for strawberries, 8. That reduces down to 1/2 a ton of zucchini for every ton of strawberries Jason produces. For Henry, the opportunity cost of 1 ton of strawberries is 3/5 of a ton of zucchini. And since Jason has the lower opportunity cost in the production of strawberries, that means Jason has the comparative advantage. If we calculated the opportunity cost for producing a zucchini, Henry would have the lower opportunity cost for that. The other type of question you could see with comparative advantage is an input question. When it's inputs, you will see a table, and the numbers in the table will indicate units of labor or land or capital that go into the production of some other good. In this case, we have hours. That's units of labor that go into the production of producing a brake job or painting a car. The formula for calculating opportunity costs when you have inputs is the IT over formula. That means the opportunity cost of A is IT, the numbers for A, divided by the numbers for B. Let's try that math out by calculating the opportunity cost of painted cars for Amy and Eric. For Amy, the opportunity cost of one painted car is the hours she has for painted cars, 6, divided by the hours it takes to do a brake job, 1. That reduces down to 6 paint jobs for every painted car Amy produces. Now for Eric, the opportunity cost of one painted car is the hours for producing a painted car, 8, divided by the 2 hours it would take to produce a paint job. That means his opportunity cost of one painted car is 4 brake jobs. And here, Eric has the comparative advantage in the production of painted cars. Now, Unit 2 is all about macroeconomic indicators, and one of the most important macroeconomic indicators is the formula for the output expenditure model of GDP. Here's our formula. It's C plus I little g plus G plus X sub N. That's your output expenditure model for GDP. So what do all those variables represent? Well, C is consumption. That's the things that consumers purchase. I little g is gross investment. Those are the things that businesses buy, specifically physical capital and changes in inventory. G is government purchases, and X sub N is net exports. That's exports minus imports. Together, we get GDP. Now here we have a table for an example. See if you can calculate GDP for an economy with these data points. Well, first up, we need to calculate our consumption, gross investment, and government purchases. Those are those first three lines on that table. Then we have our net exports. That's exports minus imports. We find that on the last two lines of that table. Add it all together and we have $66 million worth of gross domestic product for this economy. You'll notice we ignored transfer payments and depreciation. You could see some distractor numbers in the tables on your exam. Next up, we're going to look at some math for the labor force and the unemployment rate. First of all, we need to know how to calculate the labor force. The labor force is the number of unemployed people plus the number of employed people. Remember, unemployed people are people who are not working and actively looking for work. Add those together and that gives us 600,000 workers in this country's labor force. The labor force participation rate, on the other hand, is the labor force that we just calculated divided by the civilian population times 100. We have the labor force there in red that we've already calculated. That was 600,000 workers. And we're going to divide it by the civilian population. Now multiply it by 100 and that gives us 66 2/3%. That's the labor force participation rate in this country. The unemployment rate is the number of unemployed people on that chart. That's 100,000 workers. And we divide it by the labor force as a whole. That's the employed and the unemployed added together. Plug in the numbers and we have 100,000 unemployed workers divided by the 600,000 people who are in the labor force, and times that by 100, that gives us 16 2/3% unemployment in this economy. You'll notice the discouraged workers here are not counted. Discouraged workers are people who are able to work and willing to work, but they have not been looking for work. The natural rate of unemployment is an unemployment rate that is important in macroeconomics. That's structural unemployment added to frictional unemployment. Here we have a table, and let's see if we can figure out the natural rate of unemployment for this economy. Add that 3% frictional unemployment to the 2% structural unemployment, and that gives us 5% for the natural rate of unemployment for this economy. Since the natural rate of unemployment is also where the cyclical unemployment is 0, you can find the natural rate by taking the current rate and subtracting cyclical unemployment. Here we would take our 9% current level of unemployment, subtract the 4% cyclical unemployment, and that gives us the same 5% natural rate. The next macroeconomic indicator we're going to look at for this unit is the Consumer Price Index. The Consumer Price Index tracks average changes within an economy for a market basket of goods that are bought by a typical urban household. In order to calculate the CPI, we are going to take the current value of a market basket of goods and divide that by the base year value of that market basket of goods and times that by 100. Now let's calculate that with this table we have here. On that first column there, we have the market basket of goods and services. Here we have shoes, oranges, and bicycles. And there we also have the value of those items or the prices of those items in 2021. Calculate the value of that market basket using current year prices, and that is the numerator in this equation. Multiply the quantities within that market basket times the prices within that market basket, and that will give us the current value of the market basket. In this case, it's $600. Next, we're going to calculate the value of that market basket using base year prices, multiply them, then sum it up, and that gives us $400 in the base year prices for the value of this market basket. Now divide and then multiply by 100 to give us a CPI for 2021 of 150. Next up, we're going to look at the difference between nominal and real GDP. As always, the difference between nominal and real is inflation. For nominal GDP, we're going to sum the current prices times the current quantities. So we're going to take the 100 lamps that were produced in this economy and multiply that by the $45 that each of these lamps cost. Then we're going to take that total and add it to the 50 chairs that were produced multiplied by the $150 that each of those chairs cost. Then sum it all up and that gives us $12,000 of nominal GDP for this economy. Now calculating real GDP is almost identical, but this time instead of using the 2021 prices, we will use the 2010 prices. That's the base year. So we're going to take the 100 lamps that were produced in 2021 and multiply that by the $20 price from 2010. Then we're going to take the 50 chairs that were produced in 2021, multiply that by the $80 price from 2010, sum it all up, and that gives us $6,000 worth of real GDP for 2021. If we wanted to calculate a GDP deflator for 2021, we would take the nominal GDP, divide it by the real GDP, and multiply that by 100. Plug in the numbers and do the math, it gives us a GDP deflator of 200. If you are ever given a nominal value and you are asked to convert it to a base year real value, you can do that by taking the nominal value, dividing it by the GDP deflator for the current year, and then multiplying that by 100. So if these Converse All-Star shoes cost $5 in 1957 when the GDP deflator was 15, plug in the numbers and do the math and you will find the real value in 2012 for those shoes as being $33.33. If you are given two GDP deflators or two CPIs, you can calculate the amount of inflation between the 2 years through the following formula. New minus old divided by old times 100. You've seen that formula before when you were calculating your elasticity coefficients if you took micro. So if in 1995 we had a GDP deflator of 150, then in 2021 it goes up to 177, do the math to figure out the amount of inflation between those 2 years. New minus old divided by old times 100 tells us the amount of inflation was 18%. Now we're into Unit 3, and the first math we need to know is how to calculate disposable income. Disposable income is all the money that consumers have available to spend. They can either spend it or save it. And so disposable income is always consumer savings plus consumption. So if my savings is $10,000 and my consumption is $55,000, what's my disposable income? Plug in the numbers and do the math, it's $65,000. Next up, we have the marginal propensity to save. The marginal propensity to save is the percentage expressed as a decimal of new money that a consumer will save as opposed to spend. In order to find the marginal propensity to save, take the change in savings and divide it by the change in income. So if my income increases by $1,000 while my savings increases by $100, what's my marginal propensity to save? Plug in the numbers and do the math, and we have 0.1 as my marginal propensity to save. That means I'm saving 10% of any new income I receive. Marginal propensity to consume, on the other hand, is the percentage, again expressed as a decimal, of new income that is spent as opposed to save. The formula for the marginal propensity to consume is the change in spending divided by the change in income. So if my income increases by $1,000 and my spending increases by $900, what's my marginal propensity to consume? $900 divided by $1,000 gives me 0.9 as my MPC. Since all of a consumer's money will either be spent or saved, the marginal propensity to consume and the marginal propensity to save added together will always equal 1. So if I have an MPC of 0.7, what's my MPS? Do the math, it's 0.3. If on the other hand I have an MPS of 0.25, my MPC will be 1 minus that 0.25, which is 0.75. The MPC and the MPS are important for macroeconomics in determining the spending multiplier. As you should have learned, new spending, in this case consumption, will ripple through the economy, increasing GDP by a much larger amount. How much more can be determined by using the marginal propensity to save and marginal propensity to consume to find the spending multiplier. The formula for that spending multiplier is 1 divided by the MPS, or 1 divided by 1 minus the MPC, which is the MPS. If I have a marginal propensity to save of 0.2, plug in the numbers and do the math, and that gives us a spending multiplier of 1 divided by 0.2, which is 5. If the marginal propensity to consume is 0.75, plug in the numbers and do the math, and that gives us a spending multiplier of 4. Now you can use that spending multiplier we just calculated to determine the maximum change in gross domestic product that can result from new changes in spending, government purchases, net exports, or gross investment. You take the multiplier and times it by that initial change of spending. So if our marginal propensity to save is 0.75 and the government increases spending by $5 million, what's the maximum change we will have for gross domestic product? Now take that spending multiplier of 4, multiply it by the $5 million that the government increased spending by, and that gives us a maximum increase of $20 million in gross domestic product. You also need to know the tax multiplier. That's the negative marginal propensity to consume divided by the marginal propensity to save, or the MPC divided by 1 minus the MPC. If the MPS is 0.2, plug in the numbers, do the math, and we have a negative 4 tax multiplier. If the MPC, on the other hand, is 0.75, then plug in the numbers and do the math, and we have a negative 3 tax multiplier. The absolute value of the tax multiplier will always be one less than the spending multiplier. And that's because when the government decreases taxes, some of the increase of disposable income will be saved rather than spent. That's why the multiplier is lower for taxes. Now we can take that tax multiplier and put it to work to determine the maximum change in gross domestic product as a result of a change in taxes. If our MPC is 0.75 and the government decreases taxes by $5 million, what will be the impact on gross domestic product? When you plug in the numbers and do the math, we have a -3 tax multiplier. Multiply that by the $5 million decrease in taxes, that's -5 million, and that gives us a maximum increase of $15 million for GDP. Now we're on to Unit 4 with the Fisher formula. The Fisher formula tells us that the difference between the nominal interest rate and the real interest rate is the inflation rate. Here we have a formula. Little I is the nominal interest rate, R is the real interest rate, and pi is not 3.14, but it is the inflation rate. So if the expected real interest rate is 6%, while the expected inflation rate is 3%, what's the interest rate that banks are going to charge nominally? Plug in the numbers and do the math. We have a 9% nominal interest rate that banks will charge. So if I took out that loan with a nominal interest rate of 9% and the real rate of inflation ends up being 5%, what's the real rate that I actually paid? Take that 9% nominal interest rate that I'd be paying, subtract the actual inflation rate of 5%, and that gives me a real interest rate of approximately 4%. Now you can take a variation of the Fisher formula to determine the difference between real and nominal rates of change generally. The percentage change of real will approximately equal the percentage change of nominal minus the inflation rate. So if nominal wages increase by 10% while there's a 6% inflation rate, how much did real wages increase by? Plug in the numbers, do the math, and you will find out that real wages increased by 4%. Next up, we're going to move on to some bank balance sheet calculations. Don't panic, I know some people are scared by this stuff, but it's not that bad. First, we're going to look at the reserve requirement. The reserve requirement is the percentage of checkable deposits or demand deposits that the bank cannot loan out. In order to find the required reserves, take the demand deposits and multiply that by the reserve requirement. So if I make a cash deposit of $1,000 when the reserve requirement is 15%, what is the bank's required reserves after I make that deposit? Plug in the numbers and do the math. We take that $1,000 deposit and multiply that by the 15%, and that gives me $150 for required reserves. Total reserves, sometimes just called reserves, are the funds that banks have available. It's excess reserves plus required reserves. So if the bank's total reserves are $1,000, while their required reserves are $200, what's their excess reserves? Plug in the numbers and do the math, and we have $800 worth of excess reserves. That $800 is money the bank can loan out immediately. Now the money multiplier tells us how much that excess reserves can become in new money when it is loaned out, redeposited over and over and over and over again. We have a formula for that money multiplier. It's 1 divided by the reserve requirement. So if the reserve requirement is 5%, what's our money multiplier? Plug in the numbers and do the math, and we have a multiplier of 20 when the reserve requirement is 5%. Now you can use that money multiplier to determine changes in the money supply, loans, and deposits. Take the excess reserves and multiply that by the money multiplier. Sometimes you may also need to add in the initial amount if it's relevant. Let's look at the impact of a cash deposit into my checking account of $100 when the reserve requirement is 10%. Now to find the excess reserves that the bank has, we take my initial deposit and subtract the 10%. That gives us $90 worth of excess reserves the bank has. And the money multiplier is 1 divided by 10%, which is 10. So the amount of new money that my $100 deposit could create is the $90 worth of excess reserves times the 10 multiplier, that's $900. Now I'm not going to add in the original $100 deposit because that money was already cash, and that is part of the M1 money supply. Now the total amount of loans that can be created from my initial $100 deposit is again $900. That original $100 will not be added back in here because it was not a loan. If, on the other hand, I was asked how many new deposits would be created as a result of my cash deposit, I would add in that original $100 amount. So it wouldn't be $900 worth of new deposits as a result of my deposit, it would be $1,000 worth of deposits because my original $100 was in fact a deposit. Now we're on to Unit 5 with the monetary equation of exchange. Here's the formula. It's MV equals PY. What do those variables represent? Well, M is the supply of money. V is the velocity of money. That's the number of times a dollar gets spent per year on average. P is that price level, the same one you know from your ASAD model graph. And Y is real GDP, also known as real income or real output. Both sides of this equation, MV and PY, equal nominal GDP. So let's say the money supply is $10 million, while the velocity of money is 6 and the price level is 4. What are the nominal and real GDP based on these numbers? Plug in the numbers and do the math, and you will find that the nominal GDP, since both sides of this equation are equal to nominal GDP, is the velocity of money times the money supply, $6 million. In order to find the real GDP, do some algebra and take that nominal GDP and divide it by the price level. And that gives us $15 million worth of real GDP. Now, Unit 5 in part deals with economic growth. And one of the components of economic growth is changes in productivity. Productivity is the amount of real GDP per worker hour. In order to find productivity, take real GDP and divide it by worker hours. So if real GDP is $150,000 and there are 300 worker hours needed to produce that real GDP, what's productivity? Plug in the numbers and do the math, and we have output per worker hour in this economy. Another factor of economic growth is net investment. Now, this is different from the gross investment that you see in your output expenditure formula for GDP. Net investment is gross investment minus depreciation. Now, gross investment includes the new capital equipment and machines that are purchased within an economy. Depreciation is the value lost from machines breaking down or becoming obsolete. We subtract that depreciation to get net investment. That is the new amount of physical capital that has added to the economy's productive capacity. That shifts the long-run aggregate supply curve to the right and the production possibilities curve outward. If an economy has $1 billion worth of gross investment and there's $10 billion worth of depreciation, plug in the numbers and do the math, and we see that the capital stock in this economy has increased by $9 billion. The last unit deals with international transactions, and we use the balance of payments to calculate those transactions. The first component of the balance of payments is the current account. We take the sum of the money going into an economy and we subtract the money going out. The first component of the current account is the purchases of goods. We take the value of the exported goods and subtract the value of imported goods. Next, we have purchases of services. Again, exported services minus imported services. The third thing is investment income. Purchases of investments go in the capital and financial account, but income earned on those investments is in the current account. Last, we have money transfers. Money transferred out of this economy is subtracted, and money transferred into this economy is added. If the balance on goods was negative $70 billion, while the balance of services was $5 billion, investment income was $40 billion, and money transfers were $10 billion, what is the balance on the current account? Plug in the numbers and do the math, and we have a negative $15 billion balance on this current account. And since that balance is negative, we call it a deficit. Now, the balance on goods and the balance on services together create what is called the trade balance. That's exports minus imports. You already know it as net exports in your output expenditure model for GDP. You will most often see trade balance questions that deal with exports as a whole, both services and goods, and imports as a whole, both services and goods. So if a country has $35 billion worth of exports and $100 billion worth of imports, what's their trade balance? Plug in the numbers and do the math, and we have a negative $65 billion trade deficit here. And remember, the trade balance is just one component of the current account. So it is possible to have a trade deficit without having a deficit in the overall current account. Now, the capital and financial account deals with transactions of assets between countries. We take the assets sold and subtract the assets bought. Those assets include things like stocks, bonds, and even currency. So if an economy sells $70 billion worth of its assets and then it purchases $55 billion worth of foreign assets, what's the balance on the capital and financial account for this economy? Plug in the numbers and do the math, and we have a $15 billion surplus in the capital and financial account. It's a surplus because the number here is positive. Now, the balance of payments includes both the current account and the capital and financial account. Adding the two accounts together will always give you a balance of 0. And with the numbers we just saw, we had a deficit in the current account of $15 billion. We also had a surplus in the capital and financial account of $15 billion. The two of those balance each other out and equal 0 when summed together. The last bit of math you might see on your macroeconomics exam is converting prices with exchange rates. Here we have the exchange rate for the US dollar. It's $1 equals 20 pesos. That means that there are 20 pesos per US dollar. That's the exchange rate you would see on the y-axis for the foreign exchange market for the dollar. To convert dollars to pesos, you will take the dollar price of a product and multiply that by the exchange rate. If you wanted to flip that around, you will take the price in pesos and divide it by the dollar exchange rate. So if we have a Coca-Cola made in the United States that is $3 here, what's the value in pesos? Plug in the numbers and do the math, and we see that that $3 soda is worth 60 pesos. If, on the other hand, we have a 40 peso soda from Mexico, now divide by that exchange rate, plug in the numbers and do the math, and we see that the value of that soda is $2 US. Whoa, there you have it. That is all the math that you are likely to see on your AP Macroeconomics exam. If you still need more help, head over to reviewecon.com, where there's lots of games and activities to help you practice the skills that you need to know on that exam. And don't forget to like and subscribe and purchase the Total Review booklet from reviewecon.com. The link's below in the description. Take care. I'll see you guys next time.